All right, we're going to go ahead and get started. I'm excited today to present on Investing 101. So this is a presentation about getting started with investing in 2024. So we're hopefully going to give you some tips on how to get started, some of the concepts you need to know, and this will probably be the first in a series of webinars that we're going to be putting on. So without further ado, we'll go ahead and get started. So quick about me. My name is Dennis Riley. I'm the founder and principal advisor of True Wealth Strategy. True Wealth Strategy is it's a fee-only and advice-only company. And what you need to know about that is we don't advocate for any specific product or any specific company. The only product we put out there is basically our own advice to our clients. So that is our company. And then also have to start with a disclaimer that the information provided here is for educational purposes only. Because I don't know your specific financial situation, it cannot be construed as specific financial advice for you, but it is going to be hopefully relevant to everyone, good financial information, good educational material that you can then take and apply to your own situation. All right. So what we're going to cover today, we're going to go over a few concepts, and then we're going to jump into practical steps. So we'll cover a few concepts, and then we'll figure out exactly how to implement those into getting started on your investing journey. And we're going to start out with what is investing first. And the whole concept behind investing is to make your money grow. And we want to differentiate a little bit between saving and investing. Saving is simply spending less than you make. However much you make, you're putting a little bit of that away. And investing is taking that money and trying to make it work for you. There's kind of two parts to getting to wealth, and the first part is spending less than you make, and the second part is making your money work for you and grow over time. And I know for me, my parents they were great at the saving part. They were very frugal and they would save money. But the investing side, I don't think there was as many resources back then to educate people on how to do it correctly. And I think a lot of folks in that generation didn't do a very good job with investing because they just didn't have the information out there to be able to make the right investing decisions and make those confidently. So why do we invest? The power of compound interest is the quote says, it's one of the most powerful forces. It's truly, really an amazing thing. So we invest because we want the money to grow, right? So in this example, if you have $10,000 and you stick it in that savings account at your local bank, it earns about 1%. And over the course of 40 years, it becomes, it goes from $10,000 all the way to $14,000. Whereas if you had invested it in a relatively standard investment, earning about 8% over that 40-year period, now you're looking at $217,000. So why do we invest? Because we want that money to grow. And over longer periods of time, we want to take advantage of that compounding interest and really let it grow. We want to get to that point where the passive income or the income that we're getting from our investments is greater than the income that we're getting from our labor. When you're in the beginning, the majority of your income is coming in by working hard at your job and producing a paycheck. But over time, more and more of that income can be replaced by passive income, by investments that will then take the place of you having to go to work every day and you having to put in your labor. So that's a little bit of why we invest. And then also, of course, inflation. How do we deal with inflation? Because as you know, inflation is that tendency of prices to rise over time. So what $100 buys today, 10 years from now, you cannot get the same amount of goods and services for that $100. So we invest to make sure that our money is keeping up with the purchasing power. So if it's that important, why don't people do it? There's a lot of misconceptions out there, a lot of myths. And I alluded to this earlier. we don't teach financial literacy in high schools. We don't really do a good job of teaching this to most people. So some people feel it's like gambling. And in gambling, you go to Vegas, you sit at the table long enough, you keep playing, you're going to lose. Where investing is kind of the opposite. Whereas the longer you play the game, the more likely you are to be up and to make a lot of money. So it's kind of tends to be the opposite there. There is a degree of uncertainty, but over the long term, you're probably going to be making more. And you may have had a previous negative experience. Maybe you started investing, right before the dot-com bubble or one of these times. So you have a kind of bad taste in your mouth. That's where the education comes in, and we say we need to be looking at the long term. And then of course there is lack of trust. There have been scams. Bernie Madoff was a real thing. He really did fleece investors. And so that's why we're here today, is really trying to help educate folks on what they should be looking at, what they shouldn't be looking at, and hopefully you get the lay of the land so you can intelligently invest. The next concept we're going to talk about is volatility. So what was that risk that we talked about on the last slide there? Markets are very unpredictable. So why does it feel like gambling sometimes? Because we don't know what's going to happen in the markets next year. It's very unpredictable in the short term. So in the short term, the results you could look at is, the market could be down 13%, and then it could be up 5%, and then it could be up 20%. It's really hard to predict in the short term what's going to happen. In the longer term, we have very good data that suggests over long periods of time, it's probably going to go up. So the volatility, though, can scare people off. And the other kind of flip side of this is a lot of times people want to try to predict what's going to happen next year. And the purpose of kind of showing you this volatility, and this volatility, by the way, this is the performance of the S&P 500, which is the 500 biggest companies in America, and what has been the stock performance of that group of 500. And as you can see, it's up and down, and it's all over the place. So trying to predict what's going to happen next year is almost futile. It's very difficult. No one has really been able to do this with much accuracy. So just the concept here that I wanted to get across here is the market is volatile, but does tend to go up over longer periods. All right, so let's take a look at the major asset classes. So you're going to hear this a lot, asset classes and different types of assets. So we're talking about assets here, we're talking about different types of investments. So an asset is a specific investment. An asset class is kind of a grouping of those investments. And the first being cash. And that's fairly straightforward, but cash isn't just physical cash, but can also be your checking account. And also there's some things that are so similar to cash, like U.S. Treasury bills, that they act like cash. They're so safe that they act like cash. So when we say cash, physical cash as well as certain securities that are very, very secure. The next is fixed income, or most often it's bonds. So this is a category of investments that are essentially debt instruments, and we'll talk more about that in a minute. The next is equity, or you might more commonly known stock. And again, we'll dive more into that one. But there are other asset classes that are available, things like real estate, and then this big group called alternatives. And within alternatives, there's all sorts of things you could invest in. It could be crypto, it could be gold, it could be art. There are places where you can invest in wine, farmland. There's all kinds of things that could be thrown into this category. We're going to focus on the first three for this discussion. And that's because those are the easiest, most accessible to the average investor. You can get involved in these asset classes with pretty low balances and do it pretty easily. So that's where we're going to spend most of our time. Once your portfolio is getting a little bit bigger, that's when you want to start looking at some of these other asset classes. But for now, since this is a 101 class, we're going to focus on those first three. and specifically stocks and bonds. So what is a stock in the first place? And you may know this already, but hopefully we'll get a little clarity. So stocks represent ownership in a company. So you have a very small fractional ownership of that company. It's considered a quote risk on type of investment because it is a slightly riskier investment because you are now an owner of that company and you take part in the profits or the losses of that company. So it is a little bit riskier. Where bonds are essentially an IOU that a company issues. So if I'm an investor, I give, let's say it's Microsoft, I give them $100, or I'll say we give them $1,000, and in exchange for that, they're going to make interest payments to me over a set period of time, and then I will get the return of that $1,000. But they'll be making those interest payments to me, or it's a set period, maybe it's twice a year, maybe it's once a year, it could be every month, but I'm getting a set schedule of interest payments from that company over that period. So with bonds, you're getting interest. With stocks, though, how do you actually make money? If I'm an owner of this company, well, there's two ways. The first is capital gains, or simply the value of the stock goes up over time. And that's what we typically think about. So if you buy Microsoft and it's $100 a share, you think it's going to go up to $150 or $200 a share. So you buy it at $100, you sell it at $150, and you've made what's called a capital gain. The other way to make money with stock would be with dividends. So because you are an owner of this company, if the company has profits, they may choose to take those profits and distribute it to the owners of the company, which is you. So for each share you own, you would be entitled to a certain amount of the profit from that company. So we have the appreciation of the stock or the growth in the value of the stock. Then we also have those dividends. And a lot of mature companies do pay dividends. Some companies don't pay any dividends at all. But for our purposes here, we're looking at either the appreciation of the stock or that stock paying out dividends as being how you can actually make money there. So stock ownership sounds great, but it sounds complicated. I don't know which companies to buy. I don't know how many companies should I buy. So along came mutual funds. Now, in a mutual fund, a company, say Vanguard, will go out and it will pool the money from, say, 100 different investors. It'll pool that money and it will go out and buy certain stocks on behalf of that group. So you can have a professional manager now who goes out and he chooses the 20 stocks that are going to be part of this fund. And he's going to go buy those 20 stocks. He's going to maintain them and do all that work kind of for you. And you only have to put in once, you can put into that one fund, and now you have this managed portfolio of stocks. So that was a great thing. But then along came ETFs as well. So an ETF is an exchange traded fund. So in a lot of ways, it's very similar to a mutual fund in that there is this investment manager and they're making these decisions. There's a couple of small differences with how they're structured and how they play out. For the purposes of this class, they're almost identical. It's basically the same thing. It is a pool. It's pooling money from different investors and buying a basket of stocks. So when you see the ETFs, and we'll mainly be talking about ETFs, and the reason I prefer them is they can have a slightly better tax treatment, and they can be traded throughout the day. But again, for the purposes of this class, we shouldn't care about that. But I will be focusing a little bit more on ETFs or exchange traded funds. So and when we say exchange traded, that means they trade the same way a stock does, in essence. But it is going to be a basket of stocks. All right, so let's take it another step further. So we had this basket of stocks. Well, along come index funds. So what an index fund is, instead of just having your portfolio manager go out and buy these 5 or maybe 20 different stocks, let's take it another step further. Instead of buying 20 stocks, it's going to buy an entire market. And so that's when we say an index is a much bigger basket of stocks. Earlier I alluded to the S&P 500. And what that is, it's the list of the 500 biggest companies in America. So if you're a fund manager and you have to do all this homework on figuring out which stocks to buy, well, it's a whole lot easier if you can just take that list of 500 and just buy all of them. In that way, the fund manager job becomes a lot easier. And the benefit of that is that it costs less. So each of these funds that I talked about earlier, there's a company behind it. There are people who work for that company. So they have to charge certain expenses to keep their company running. And those expenses get passed to the investor. So when you can keep the expenses really low, the investor gets charged less and ends up with more in their pocket. So with index funds, the concept here is you buy the whole market rather than having the guy, some very highly educated, very well-paid guy trying to pick the individual stocks. You buy the whole market. And it's a little bit counterintuitive, but when you buy the index, the actual results that we've seen, index funds generally outperform those managed funds, those ones where there's a guy there and he's picking the stock. He's doing 80 hours a week trying to figure out which stocks to pick. These index funds that buy the whole market have outperformed, especially when you take into consideration the additional fees that are associated with them. They've outperformed those managed funds. So index funds are also called a passive approach because there's no one there really actively figuring out which stocks to buy and sell. He's just buying the whole market. So the index fund, the performance of these has been very good. I kind of prefer them. We'll talk more about them later. But so now let's talk a little bit about the trade-off with risk and return. So we talked a little bit about the risk. We had this market volatility and it's going all over the place. And we talked about how cash is very stable. The value of it's not going to change that much. But as you go up to the right on this graph, you'll see things like stocks, cryptocurrencies. Yeah, you've seen the crazy fluctuations in the price of cryptocurrency. Well, in general, investors want to see a higher rate of return if that asset is more volatile, if it is riskier. You generally expect a higher rate of return. And there's generally this trade-off. So cash, and again, no real rate of return, but it's very, very safe. You're not going to lose money. So that's good. Now move up to things like bonds. Now bonds give you a little bit better rate of return, and they're still pretty safe, but they're not going to give you that big return. So now we move up to stocks and cryptocurrencies and things like that. And they're going to give you, over a longer period of time, they're going to give you a nice big return. But in the short term, who knows? It could be down 20% in the next week. We don't know. So there's that greater degree of risk, and so that's that trade-off that you have to balance. We want a high return, but we also don't want to lose all our money in a week. So the next concept I want to kind of introduce is within, we said stocks is kind of one category, but it's actually several categories inside of that one that we called stocks. Over on the right side, you'd see equity segments. So when we can break up stocks into different categories, it could be the orange one here is the large cap. So that's when I talked about the 500 biggest companies in America. But then there's also international. There's also those emerging countries that are growing really fast, but not quite. Their markets aren't quite as developed as like the U.S. and Europe and some of the more developed countries. So we have international, we have developed, we have emerging. So which one is the best? Out of all these different categories, okay, which one is the best? Because we want to invest in the one that's the best, right? Well, we don't know. So you can see here on this colored chart, in 2006, the one that did the best was international real estate. But then by 2008, it was the worst performing. And so you'll see this kind of theme of these are moving around, when some will be the best performing one year and the worst performing the next year. So we don't really know even even within stocks, we don't know if it's going to be up or down, but also within stock, we don't know which category of stocks is going to perform the best. Which leads us to diversification. And as a concept, when we talk about diversification, what we mean is almost literally don't hold all your eggs in one basket. And what we mean, so don't just hold Microsoft stock. Of course, if you hold just Microsoft stock, you would have done well recently, but that could all change very quickly. There's a whole lot of risk with holding only one company. So when we talk about diversification, we mean you should own a bunch of different companies, okay? But not just a bunch of different companies. So when we say within an asset class, so within the category of stocks, you should own a whole bunch of different companies, but also you should diversify across those asset classes. So don't own just stock, but you should own stocks and bonds and real estate, or you own this variety of different asset classes, as well as within the asset class we diversify and we own multiple investments within that asset class. Then we also have multiple asset classes because again we don't know which one is going to do really well, which one is not going to do well. So over time, if we diversify that, then we'll see better performance overall. And one easy way to achieve that diversification is we talked about earlier, these index funds, they buy literally the entire market. So in some of them, you're buying thousands of different companies, all with a single investment. So that's a great way to do it. All right. So the next concept that I want to go over is investment costs. So earlier I kind of alluded to this Vanguard, this company. They have a guy who is their he's portfolio manager. He's the one buying and selling the stocks, and they have someone who's doing marketing. They have a building. They have costs, and those costs get passed to the investor. So one thing that you can control as an investor, you can't really control that volatility or what's going to happen in the market. But one thing you can control is what are the investment costs of the investments that I'm making. So we can choose things that have very low expense ratios. They're called expense ratios. And there are also funds out there that have very high expense ratios. So why is this important? Well, over a long period of time, those compound and make a pretty big difference. So here we have in this graph, there was a $100,000 investment initially over 30 years. And if it was a very high cost fund at say 2%, you ended up with 317,000. But if it was a low cost fund, you ended up with 557,000. So it's a dramatic difference. It may seem like a small number, this 0.5% or whatever this small percentage is, but over time it makes a very big difference. And just to show you, so one of the things we've been talking about these index funds. So how do I know it when I see it? If I'm out there looking at different funds, how would I see it? So I just pulled this off of Yahoo Finance. This is one of these big index-based ETFs, and this one happens to be the Vanguard stock, entire stock market. So it basically invests in the entire market. So what would I be looking for here if I'm trying to do what I've been saying? Well, there's a couple things. That expense ratio that we're looking at here, that expense ratio is showing 0.03, and that is very low. That's a very good expense ratio. Someone was showing 1% or 2% or even higher. So an expense ratio that's really low. And then you can look in the description, and in the description it will tell you, is this fund based on an index? How are they investing the money? Is it actively managed or is it passively managed? And here, if you read this paragraph, you can see that it is a very passively managed fund. It invests in the entire stock market. So again, if you're looking at individual funds, those are a couple things that we want to look at based on what we've so far what we talked about. And by the way, this is not an endorsement of this fund. This just happens to be one that meets that criteria that we've been talking about. The final concept that I want to talk through is the tax implications of investing. And tax implications can have a huge impact on the amount of money you end up with. So you want to know what is the tax implications of the investments that you're choosing. And earlier we talked about capital gains, or the if a stock goes up in value. If a stock goes up in value, maybe you buy for $100, and at the end of the year it's worth 150. Well, you're not going to pay taxes on that unless you sell the stock. So if you say you bought a stock right now and you sell it 20 years from now, well, you're not going to pay the tax on that until you sell it in 20 years. But if you're invested in something like bonds, you're getting interest or dividend income, that all becomes taxable immediately. So as soon as you receive that dividend, as soon as you receive the interest, you pay the tax on that immediately. So there is this preference for holding, especially stocks for kind of longer periods, rather than receiving that income earlier and then having to pay tax on it. So there's an illustration here of if you only had to pay tax at the end of the period, you end up with $12 million. And if you had to pay it every year, so if the income was coming in the form of like dividends, you would end up with only $6 million at the end of that 30-year period. So just an illustration that taxes matter, and understand how your investments are being taxed. So a quick summary of what I've been talking about so far with investments so far. You want to focus on things that you can kind of control, things like the costs. We want to make sure we're broadly diversifying. When we looked at that chart of the compounding interest, we want to start early, as early as we can, and then keep investing, invest regularly, and having that long-term perspective, not worrying about what happened this year, what's going to happen next month, but keeping the perspective of kind of longer time period. And then if you can minimize the tax impact, that's always advantageous to try to minimize the tax impact. And asset allocation, we haven't talked too much about this, but this kind of goes in with the diversification. Asset allocation is the mix of different assets that you hold. And we'll actually go into that a little bit more later. All right, so now let's switch over to the more practical side. Okay, how do you do this? How can we start doing this right now? So this is the process that I will actually go through with clients as well. And you can go through this same process to choose your investments and get started. So the first is defining goals. And you can go kind of down a rabbit hole talking more about this and how to define them. For today, we're just going to say we need to define our goals. What are they? What is how long out are they? So things like I need to pay for college for my kids. Well, that could have other implications like the types of accounts to use and the timeline, a lot of different things. So we want to make sure we're identifying what are the goals of our investing, like why are we doing this, and when is the money going to eventually be used? And I guess the other thing to say here is, and it is perfectly acceptable to say my goal is just general wealth building. That has certain implications, but that's certainly a valid goal as well. So once we've determined the goal, we want to align it to the right type of account. So the step 2 is choosing the account type. So the first category here we have on the top is taxable accounts. So earlier we talked about the importance of the tax implications. So in this first category, we have just your normal savings accounts. Go down to the bank, get a money market, a CD, a savings account, these type of accounts. And they could be ideal for something that's short-term in nature, emergency fund, that kind of thing. But then you have your brokerage account. And this is your standard brokerage account. You go down to Schwab and you open an account. That will be a taxable account. But you do have to pay the tax if you realize gains. But it also offers you the highest degree of flexibility and the greatest number of investment options. So there are advantages to having this type of account. But if you have the opportunity to have a tax advantage account, there's obviously more advantages on those. So I'm going to go into a couple of those types of accounts specifically, and ones you really should be aware of. And the first being a Roth IRA. This is one that some people don't really know about, but you have the opportunity, provided that you meet certain criteria, like income restrictions, to contribute to a Roth IRA. So an IRA being an individual retirement account, and a Roth means that what you'll contribute money into the account, and the money you're contributing is after-tax money. So you'll take money from your paycheck that's already been taxed. You'll take that money, you'll put it into this Roth IRA. Well, the beauty of the Roth IRA is that it's going to grow over time. And remember, we said those taxable events. Well, this can, even if you do sell the stock, it doesn't matter. You're not going to get taxed on it. You're going to grow tax-free until you take it out. And even when you take it out, you're going to be able to take it out completely tax-free. So it's going to grow this whole time. And all of that, the accumulated gains you're going to have, you're going to take them all out tax-free. And that's a huge bonus. There are also advantages of a Roth IRA over a traditional IRA in the flexibility to take money out. It's a great account. It is limited though. So the government limits the amount you can put in here. Right now, I think it's 7,000 or 8,000 if you're over 50. So there are contribution limits. There are restrictions based on your income, but it is a very powerful account that you should be thinking about, especially for some of these longer term goals. The next is your employer sponsored retirement account. So this is, most of us have access to like a 401k or a 403b or these types of accounts through our employer. The main thing to know on these, you often get an employer match. So that's, if I put in 2%, my employer is also going to put in 2% of my salary. So these become almost a no-brainer. These are almost like free money if your employer does offer that employee match. So you definitely want to take advantage of that. Some employers offer a Roth version of a 401k as well. And those can be very powerful for folks, especially if you think your tax rate is going to be higher in retirement than it is now, because the difference, I kind of alluded to this earlier, but with a Roth, you don't pay taxes when you take it out. You pay taxes up front. And a traditional 401k or IRA, with those, you don't pay taxes up front. So they pull it out of your paycheck before taking taxes out. But then in retirement, you then have to pay tax on that entire amount. So it becomes income that you pay tax on in retirement. So there's different trade-offs between traditional and Roth when it comes to the 401k. And you really kind of have to look at your situation and see which one is best. The last type of account that I want to talk about is an HSA. And so an HSA is a health savings account. And a lot of folks use this. You put money into this health savings account. It goes in tax-free. It grows tax-free, like we were saying with the IRAs, but you also get to take it out. When you withdraw the money, it's also tax-free. So this is the only type of account in this country that offers you what's called triple tax advantage. It goes in tax-free, it grows tax-free, you take it out tax-free. It's the only type of account that does that. The drawbacks are that you have to have a high deductible medical plan through your employer, and not everyone does. But if you do have that, then you become eligible for this HSA. And the HSA is often overlooked as a retirement account because often people use it, they put the money in there and then they immediately spend it on their medical bills as they come due. But a lot of times when I work with clients, we talk about using this basically as a retirement account because of that triple tax advantage. It's going to grow and provide you more after-tax dollars in your retirement years when you're probably going to have higher medical bills anyway. So it actually is a great option for retirement planning as well. So highly recommend that one. So step 3 in the process is choosing a custodian. So we know what goal, we know what type of account is the best type of account for that goal. So now we need to go open that account somewhere. So we're gonna choose what's called a custodian or a brokerage, and work to open this account. So there are three main big players that we're talking about: Vanguard, Fidelity, Charles Schwab. If you're going to ask me to choose between them, they're all three good. I'm not going to say one is really that much better than the other. Vanguard is usually known for being really low cost, but Fidelity, Schwab, these are great options. I've had accounts here. Pretty much can't go wrong choosing one of these big guys. There are alternatives to the big brokerages, things like Robinhood, Webull. These are kind of newcomers. Sometimes they offer little incentives for you to open an account there. So you might want to look at those incentives, but for the most part, if you are starting out, I would recommend going with one of the big brokerages, just because they're probably going to offer you the easiest process, the most stability. Vanguard's not going away, Fidelity's not going away, so we can have some confidence with them. But the other consideration with choosing one is, do you already have accounts with one of them? So you may already have like a retirement account, or maybe it's a 529 plan for education. Maybe you already have some accounts with one of these guys. Then I would say stick with it. Just to keep it simple, keep your accounts in one place. There's some advantage to that. So for the most part, though, you're not going to go wrong. Choose one of these and you're fine. On the other hand, there's also what are called robo-advisors. So a robo-advisor sits somewhere between really what we're talking about here, which is kind of do it yourself, and walking into a financial advisor and handing him all your money and having him do everything for you. Now, those things are good options if you want to completely hand it off to a financial advisor, but that financial advisor is going to charge you money to do that service. Doing it yourself can be tough. So there's a middle ground here of using what's called a robo-advisor, and the biggest players in this space are Betterment or Wealthfront, and there are some others, but those are kind of the big ones that I hear about the most. So a lot of folks think, well, if you're a financial advisor, you probably don't like robo-advisors. No, I love them. I think they're a great option. And what they can do for you, you go onto their site, you choose the goals, kind of what we talked about earlier. You choose the goals, you choose the accounts, and they tell you what you should invest in. They kind of give you automated options, and they'll automatically rebalance your account for you. Basically, there's a lot of automation here. There's a lot of advantages to doing it this way. They are not free. You are going to pay, but you're certainly not going to pay as much as if you handed your money to a financial advisor and had him do it for you. They're going to take advantage of all that automation, and the fees you pay are going to be substantially less. So, in my opinion, a robo-advisor can be an easy button, and I do think that, especially as you're starting out, this could be a really good option for you. Is go to Betterment and go through the same steps we've already talked about, but use that robo-advisor to pick the investments for you. Once your account gets a little bit bigger and your situation gets more complex, that's when, okay, maybe you do need to talk to a financial advisor or somebody else and not have it completely automated. But as you're starting out, especially, I think robo-advisors are a great option. Okay, the next step in the process, so we have our account with this custodian. All right, the next step is the asset allocation. We alluded to this earlier. What is the asset allocation? The asset allocation, which is probably the most important decision that you're going to make in this whole process, is the amount of stock versus how much in bonds versus, what is the amount of money we're putting into each of these buckets. That's called the asset allocation. So to determine your asset allocation, there's 4 steps here. Again, revisit the goals, make sure we remember what goals we're looking at. The next one is your time horizon. So if we know the goal, we should know the time horizon. So if it's retirement, and I'm 40 years old, then 40 years out, well, I plan to retire at say 65, so that's 25 years. I know my time horizon, 25 years, versus I'm buying a house next year, and my time horizon is only 1 year. And when we know the time horizon, we know that it'll impact the amount of risk we can take. Because if we're looking at 25 years, well, I can be a lot more aggressive and put more in stock and more in aggressive investments, because over time, those are going to do better. But if I have a shorter timeline and it's only like 1 year, well, I need to keep my investments pretty safe, because I can't handle that 20% downturn in the market, because I need to spend that money next year. So identifying that time horizon is the next step. And then we need to look at our risk tolerance. So risk tolerance is made up of two pieces. Number one is your willingness to take risk. So when you talk about your willingness to take risk, that's saying, if I invest all my money in the stock market right now, will that keep me from going to sleep at night? Am I just not a risk taker? Maybe some people just are naturally just risk averse, and having their money in the stock market, having all their money in the stock market, they couldn't handle that. They would be up at night. They wouldn't be comfortable with that. So we need to assess your willingness to take risk, and then also the capacity to take risk. And that was in large part what I talked about with the time horizon. Do I have the ability to take on more risk, or do I need to keep it less risky? I may have a very high willingness to take risk, but I don't have a real capacity to take risk. So we have to balance those two. And I've included a questionnaire that you can take on your own. It includes scoring as well. It's from Forbes. So you can actually take that risk assessment on your own. So you can figure out kind of where you sit on this continuum. So once you have that risk tolerance, where does that fit? Can we be very aggressive, or do we have to be pretty conservative? And just to kind of illustrate, this is the exact same process that I go through with my own clients. This is it's called an investment policy statement. And for each client, this is Mr. Marcus Aurelius. He's 35 years old. He has a savings account that is his emergency fund. So the strategy we use for that is just cash. But in his 401k, he's 35. He's not going to retire for 30 years. For that account, we're going to use an aggressive growth strategy. So when we have these strategies, what does that look like? So here is an example of asset allocations. This isn't the only answer, but this is an example. So in step 5, now we're saying, we've got this asset allocation. What specific investments are we going to invest in? And you can see if we were using that retirement example, I could go to the aggressive allocation. And in the aggressive allocation, it's 50% of it is in large cap stocks. So we said like the S&P 500, the big companies. 25% of it's in international, and another 20% is in small cap. So small companies. So that combination, it's 95% stock. And so that's a pretty aggressive. That's a very aggressive allocation. But you need to decide kind of which one aligns to your time horizon, your goals, your risk strategy, which allocation here makes the most sense. And then once you've decided that, what I would generally do is take that asset category and find one of those funds that we had talked about earlier, a low-cost index fund, passively managed index fund that matches that category. And you can go to whichever company you're with, Vanguard, Fidelity, Schwab, they all have these funds, low-cost, index-based funds that meet all of these buckets. So it's fairly easy to find them. You can also, quick Google search of index-based ETF for international stocks, and you can find them pretty quickly. The last thing I want to comment on here is target date retirement funds. So a lot of times in like a 401k, or if you just go to some of these brokerages, an option is to use what's called a target date retirement fund. The benefit of these is that with a single investment, it is going to give you the correct allocation of stock, US stock, international stock, bonds. It's going to give you the correct allocation for your age and the date that you plan to retire. So it's completely automated. You're going to make a single investment. The only decisions you're going to make are which year you're choosing for the target date and then how much money to put in. So it can be a really simple way to automate this whole process. It's automatically rebalanced based on your age. So as you get closer to retirement, it's going to become more conservative. So if you put the money in right now and you're 30 years old, it's going to be mostly stock. But as you get closer to retirement, this fund is going to automatically pull down the amount of stock and increase the amount of bonds because you just can't take on more risk because you're so close to retirement. So to me, again, this is an easy button. This makes it easy. You've made a single investment, and it's one and done. I do have to mention that sometimes these funds get heat for being too conservative, or being maybe they folks think they have too much allocated to international stock. The thing you have to know is, yes, you do give up some control for the sake of simplicity and for the sake of kind of automation and making it easy. You do give up some control in these funds. So you have to be okay with that balance. But for so many investors, these funds, I believe, are correctly allocated. But you do have to make sure that they are still a low-cost fund, like we talked about, because some are not. So you do want to make sure it's a reputable company with low cost. But I do think these are a great choice, especially in like 401ks. And these are usually a really good choice. The final step, and this is, to me, this is a very important one. And you may not think of it. So you've opened your account, you've chosen the investments. The next step is to automate it. And through the big brokerages that I mentioned, this is fairly straightforward. But the power of automation here is going to be, it forces you to have that discipline to keep investing every month. So what you'd want to do here is set something up where every month you're putting in 100, 200, 500, $1,000, whatever you can afford, whatever you want to contribute toward those goals. It's going to force you into that habit and make sure that you are continually investing and putting money into this kind of long-term success. So again, all the big brokers allow you to do it. I think it's a quick process, and I think it's going to be a big one to really contribute to your long-term success. So finally, avoiding common investment pitfalls. In the last few minutes here, I just want to mention some of the mistakes that you see investors make. The big one is making impulsive decisions. We talked about that volatility. It's a fact. The stock market could go down by 20%. And if it does, a lot of times the tendency is, oh no, it's down by 20%. It's going to keep going. I need to pull out my money now. Or if the stock market's gone up, tremendously, it's gone up 50%. It's huge. It can't stop. It's going to keep going. So then you get in. And inevitably, what happens? It tapers off and starts to fall. And then it falls by 20%, and then you take it out. So you're buying it high and you're selling it low. So that's probably the biggest mistake that I see over and over again, is people making these impulsive, emotional decisions. When what you really want to do is be patient. Be patient, be disciplined, understand that you created a plan, you took the time to create this plan, and you need to stick to it. If you stick to it, you will have the long-term success. So don't chase the hot thing. Make your plan, stick to it, be disciplined, and then the other part of that is stay focused on the goals, on what your goals really are. The other thing I see a lot is the goalposts move. So you get to a certain amount of money and you say, well, this is good, but what I really want is this other level and another level and another level. And you're never content to say what I have is enough. So keep the goals in mind. the specific goals that you started with. You want to retire at a certain age. You want to give a certain amount to children or to charity. Keep that in mind, and then also focus on what you can control. You cannot control what's going to happen in the market, but you can control things like keeping your fees low. You can control your asset allocation. You can control that discipline of investing regularly. Those are the things you can control. And there's a lot that you can't control, but let's focus on those things that we can control. All right. With that, I wish you the best of success in your investing journey. And if there is any other questions, feel free to reach out to me. Go to www.truewealthstrategy.com, and I'll see you on the next webinar.